Welcome back to the show, and let's put the spotlight on the Deal Tracker segment for the month of July. And we have with us Prashant Mehra, who's the partner at Grant Thornton Bharat. Prashant, always a pleasure to welcome you on CNBC TV18. For the month of July, the data that you have collated at Grant Thornton Bharat, you did mention that the volume has not been that high in terms of the number of deals versus YOY, but the value definitely has increased because of the upliftment in some of the big ticket deals that we have seen. Give us a view on what has been seen, and is that trend continuing now?
Thank you. Firstly, thank you for having me here. Yes, I would say that, if we compare the year to date between July of this year to July of last year, the deal activity has certainly gone down, both in terms of value and volume. But one reason for that, besides the global economic situation, is also that we had some very large ticket deals in last year's 7 months, which is the Adani deal, the Mindtree deal, as well as the HDFC one, which were the 3 big ticket deals in the last 7 months of last year. This year, there haven't been too many big ticket deals. That's one reason. And second thing is that, of course, there is that global meltdown. But if we look at July in particular, what is very encouraging is the fact that both from a domestic M&A perspective as well as a cross-border perspective, there's been a surge of deals, and about 9 or 10 big ticket transactions have also been there. And where that's really coming from is the fact that the industry mix has actually gone outside of pure startup or technology, and we've seen the emergence of retail deals, we've seen the emergence of automotive deals, we've seen, of course, fintech as well, but also manufacturing, which all is very encouraging. And as we move towards the H2, which is usually about 60 to 70% of the deal values within a calendar year, I'm sure at least domestic M&A will pick up, including cross-border. As far as private equity is concerned, will probably still remain tepid for the rest of the year as well.
Right. Would you agree that private equity has made a killing by the returns proposition in terms of the block deals that they have done in the last couple of months? And how are you seeing that building up now?
No, absolutely. I think they've done very well, and the focus is more on exits, because a lot of their investments are now maturing. Thankfully, last month we've had some good run with the IPOs as well. There've been 3 major IPOs and some QIPs as well. So the focus probably is more towards exits, monetizing the investments which have already made, and then looking at investments from a new horizon perspective from 2024 onwards.
That's right, Prashant. In fact, a lot of return proposition by way of the equity window that was provided. But of course, market volatile right now compared to that. But given that the opportunity was given in terms of the valuation and some ramp up has happened, and looking at the economic scenario where it could be difficult going forward as well, a lot of promoters have also put their companies on the block. Is that what's going to drive M&A? Is there valuation mismatch on that front? And how is private equity looking at it, especially the ones who are really attracted towards control deals, and once in a while only these opportunities present themselves?
Yeah. All very great questions, and I will just answer that in 3 parts. One, as far as opportunity is concerned, yes, definitely, because of the valuations were normalized, there was an opportunity, but probably that was offset with the fact that the cost of capital went up substantially. I mean, most of the deals are actually leveraged deals, and if the cost of capital has gone up, especially cost of debt has also gone up, it just the benefits of lower valuation versus what it takes to raise capital is probably setting itself off, and that's the reason why that has not been monetized, that situation. As far as promoters putting their companies on the block, I think that's really being driven from 2 things. One, there is a huge working capital strain on perhaps all companies. Working capital post-pandemic, we saw that working capital investment reduced substantially, but it has actually gone back to pre-pandemic times. So investments are largely targeted towards organic growth into working capital, since bank finance is no longer very cheap. And that's probably one reason why promoters see still a lot of potential in their businesses, but would like to put them on the block to also help drive consolidation in the market, which I've always believed will be financed by the private equities, because that is the alternate means of financing, especially where India is concerned, where
Right.
acquisition financing is not necessarily a medium.
That's right. The economic factors, especially the interest rate cycle, really not turning anytime soon. That is also putting a lot of impact on the M&A, and funding is required. But finally, very quickly, Prashant, leave us with a few key themes on M&A that you're seeing right now developing in the couple of months.
I would say two things. From an outbound perspective, there will be more action, because there are a lot of assets which are becoming available overseas, whether they're tangible or intangible assets, but largely intangible. And I think Indian companies would look at getting a piece of that. As far as domestic market is concerned, largely consolidation in both the manufacturing as well as the service industry. But if I were to put my money somewhere, I think from a long-term perspective, it could be manufacturing for the next 6 to 12 months.
All right, manufacturing going to see a lot of deal activity. Thanks, Prashant, for joining us with all those important insights on the deal street. With that, it's back to Sonia.
Thanks a lot, Nisha, for that. Well, let's do one thing.